Hey everyone, welcome back to Corporate Decoder, the place where we uncover the hidden stories within today's financial filings. Today we have a report from the Federal Home Loan Bank of Dallas. It's a current report. So get ready for some immediate insights, not a lot of fluff here, just the facts, and trust me, the facts can be quite interesting. And before we dive deep into this report, if you find value in decoding corporate documents and getting straight up insights, make sure you are subscribed for more. Also, we have a fantastic community over on Discord. The link is in the description where we break down these filings even further. So Federal Home Loan Bank of Dallas, or FHLB Dallas as we'll call them, is filing a current report that tells us about some new financial obligations they are entering into. Now straight away they tell us that most of their money comes from selling debt. Think of it like this: they issue bonds and notes to the public to get the cash they need to operate. These are not just their obligations, but also the obligations of all the other federal home loan banks working together. But, and this is important, these are not backed by the US government, so while they are a significant financial entity, they operate on their own financial strength. Now the really interesting part is a table that shows us specific bonds they plan to issue. This is like a peek into their upcoming borrowing plans. They've provided a summary of these consolidated obligation bonds that they've committed to issue. They're being upfront that these are bonds they've agreed to sell, with specific details about when the deal is made, known as the trade date, and when the money actually changes hands, the settlement date. Let's look at the first one here. The trade date is the 24th of November, 2025. The bond matures on the 24th of November, 2032. That is a 7-year term. This bond has an initial coupon rate of 4.280%. That means it pays out a little over 4% interest each year, fixed. What is neat about this particular bond is its call type. It is an optional principal redemption with a Bermudan call style. This means they, the bank, have the option to pay back the bond early on specific recurring dates. The next opportunity for them to do that is the 24th of November, 2026, and the amount they are looking to raise with this bond is a solid $10 million. Then we have another one just a day later, the 25th of November, 2025. This one has a much longer maturity date, the 12th of December, 2035, making it a 10-year bond. The interest rate here is set higher at 5.000%, a full 0.5% more. This bond also carries an optional principal redemption, but with an American call style. This means they can potentially buy back this bond anytime from the first call date, which is the 12th of June 2026, all the way up to the maturity date. This gives them a lot of flexibility if interest rates drop. This issue is for a larger amount, $15 million. These optional principal redemption bonds, also known as callable bonds, are a common tool for financial institutions. They allow the bank to save on interest costs if market rates fall below the rate they are paying on these bonds. If rates drop, they can buy back the old higher interest debt and issue new debt at the lower rate. The Bermudan versus American style just defines how often and when they can exercise that call option. Bermudan gives them specific dates, while American offers more continuous flexibility. You'll notice both of these bonds are listed as fixed constant for their rate type and subtype. This means the interest rate we see quoted is what they will pay for the entire life of the bond, with no surprises or changes unless they decide to call it back. Finally, we get to the sign-off. The report is signed on behalf of the Federal Home Loan Bank of Dallas by Katie Watson, who holds the title of Vice President and Director of Financial Reporting. The date of the report is the 1st of December 2025, which is shortly after the dates mentioned in the bond issuances, making sense as they are reporting on these commitments. Now, what does this all mean for FHLB Dallas and for us watching? Well, they are actively managing their debt. They are issuing new bonds, which confirms they are continuing to borrow from the market to fund their operations. The fact that they are committing to these specific issuances, with details on interest rates and maturity dates, shows a clear strategy in how they are managing their financial obligations. They are locking in borrowing costs, and by offering callable bonds, they are building in flexibility to adapt to future market conditions. What is interesting is that they themselves state they have not made a judgment as to the materiality of these specific consolidated obligation bonds. This means they are reporting these issuances as part of their ongoing operations and not marking them as exceptionally significant events in isolation. However, taken together, these issuances represent significant amounts of future debt that the bank will be responsible for. They also point out that Schedule A, the table we just looked at, does not include short-term discount notes, which are issued daily in the ordinary course of business. Nor does it account for whether the money from these new bonds is simply replacing old debt that is maturing or being paid off. They do report their total outstanding debt in their regular periodic reports to the SEC, so if you want the big picture of their total borrowing, that's where you would look, looking at the rates 4.280% and 5.00% for 7 and 10. Year terms in late 2025 might seem reasonable depending on the prevailing interest rate environment. The fact that they are willing to pay these rates and offer callable features suggests they believe these are good terms for their current needs. Overall, FHLB Dallas appears to be operating with a well-defined debt issuance strategy. They are raising capital strategically, and the inclusion of callable bonds shows an awareness of interest rate risk and a desire to manage it proactively. The primary risk here, as with any financial institution relying on debt markets, is the broader economic environment and interest rate fluctuations. If rates rise significantly, the cost of their borrowing will increase, and if they cannot manage it through their asset portfolio or by refinancing, it could impact their profitability. However, for now, these filings suggest a controlled and strategic approach to their financing. Alright, that is our breakdown of the Federal Home Loan Bank of Dallas's current report. What is your take on these numbers and what they signal for the bank's future? Drop your thoughts in the comments if this analysis was valuable. Hitting that like button really helps. And subscribe for more deep dives. Don't forget to check out the Discord in the description for more detailed discussions. Thanks for watching, see you next time.